07, Passive Activity Loss Limitations. This is the 39.6 Facebook and YouTube Live Finance Show. The show that teaches high earners like yourselves how to make your money work for you, so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. In today's episode, we answer a question from somebody in our Facebook community, 39.6 community. Kevin says, newbie question. My wife and I are both W-2 physicians and looking to invest/tax shelter. We naturally began to get attracted to rental real estate. Since our combined income is over $500K, congratulations, would rental properties bring down our taxes owed on our W-2 income? Can somebody please explain how the $150,000 max yearly income and excess losses work for high income earners? Anywhere else I should look to invest to help lower my tax burden? Thanks ahead of time for your help and advice. All right. So I haven't actually formally done an episode on this, on the passive activity loss limitations. Now, Schedule E is where passive income goes. So that's any regular rental activity. Now, this does not include rental activities that are considered active income and would go on Schedule C. Okay. But any long-term rental generally would be considered a passive rental, even if you have active material participation and you are in managing the property yourself. Okay. So there are some rules as to who can benefit from the losses. So there are what we call the passive activity loss limitations. When you have a rental property, you have your income and your tax deductions, and one of those tax deductions is depreciation. So usually you will have a negative number for your rental income from a taxable perspective. It is a taxable loss, okay? If your modified adjusted gross income, your MAGI, which is basically your adjusted gross income, but it has some modifications. So if you took a deduction with an IRA contribution, you can't count that. You have to put that money back in. Social Security does not count to this adjusted gross income. There's a lot of different modified adjusted gross incomes they use to see whether or not you qualify for certain things. For example, if you can contribute directly to a Roth IRA, there's another modified adjusted gross income that you use to calculate your eligibility. Okay. And I just pulled that up here just to kind of show what those modifications are. Okay. But as long as your modified adjusted gross income is under $50,000 if you're single or married filing separately, or under $100,000 if you are married filing jointly, then you are allowed to take the negative taxable income from your rental property, which would go on Schedule E. And that Schedule E loss will get transferred to your 1040 form, and you'll have a negative number, and that will offset other income like your W-2 income. Okay, there's a limitation on how much loss you can apply. You can apply a loss up to $25,000. Okay, so you could have one property that generates, let's say you do a cost segregation analysis on a single family property, because currently you're allowed to take, and let's say you take bonus depreciation if it's a relatively recent property. You can do that, and you could generate, let's say, $100,000 in losses. Well, if your income jointly is $100,000, then that $100,000 loss, $25,000 of it, you could apply onto your 1040 for that tax year, and it'll save you $25,000 of taxable income. Now, If your income is only $100,000, you're actually only in the 12% tax bracket. So that $25,000 of deduction will only save you 12% of that. So it's about 1/8 of it, so around $3,000. Okay. But you're only able to take $25,000 loss. So the other, you have, let's say 25, 25, 25, and 25, 100,000. You use one of it up this year, and then another 25,000 you can use the next year, and the next year, and the next year. Okay, because whatever you don't use gets carried over to the subsequent year until it's all used up. Now, that works out great if you earn 100,000 or less in modified adjusted gross income. Let's pretend you make like $120,000. Well, you could put 19,500 of that into your 401k at work. Okay, and that'll get you down to around $100,000 so that you would qualify. Okay, those deductions, 401k contributions, deferrals, those don't even show up in your W-2 wages. So it's a way to, it's not an above the line deduction, it's an off the page deduction. It doesn't even show up on your taxes. So taking these things like a 401k deferral or a cash balance pension, those can take money off of your taxes so they don't even show up. And so it can help you become eligible for some of these other benefits. Okay, like qualified business income deduction, or eligible for rental deductions, to get you under the limitation of passive activity losses. Now, if you make $150,000 or more and you're married, you cannot take any passive losses. So even if you have a negative $100,000, all negative $100,000 would just get carried over to the following year and continue to get carried over until you can get under $150,000. Now, the reason why I said $100,000 earlier and $150,000 now is because if you're at $100,000 or less, you can take the full deduction up to $25,000. However, if you are between $100,000 and $150,000, there is a phase out of how much you can take. So it starts out as up to $25,000, but as you go up to $150,000, for every $2 you go up over 100, you lose $1,000 of your allowed loss. So by the time you get to 150,000, you're allowed to take only 0. Okay, so it phases out that benefit. But if you're at 150,000 and you could take $50,000 off by doing a 401k for yourself, 401k for your spouse, and other things, then you could potentially get yourself into the window where you could take this loss. However, again, the benefit isn't huge because it's only at the 12% tax bracket. Now, that is the one main exception to who can actually take losses off of their 1040 based on schedule off of passive income are people who have an income under $150,000, but it's also cut off at $25,000. The big exception, which applies to fewer people, is the full-time real estate professional status. If you do qualify for full-time real estate professional status, one person out of the married couple, then 1, there is no limit to your income, and 2, there is no limit to the loss. So it's not cut off at $25,000 anymore. It's cut off at infinity. Okay, so you could have $10 million of earnings, and you could have $12 million of losses from real estate, and you would have a negative $2 million. It's just the way it is. Now, this does not account for, again, active businesses that would go on Schedule C. Okay, this is only for Schedule E, passive losses. So Schedule E for most high earners, assuming you don't meet full-time real estate professional status, that is where losses go to die. They just kind of get put on Schedule E, and that loss just carries over and carries over and carries over and over until you get your income down to 5 figures. Okay. I wouldn't recommend decreasing your income to 5 figures just to take advantage of some built up losses, because it's not even that much of a benefit anymore. It's like $3,000 something in tax savings. It's not that big a deal because it's cut off at 25,000 and it's only at the 12% tax bracket. All right. So that is episode number 107. If you want to take losses, Schedule E losses without full-time real estate professional status and with an income over 150K, it just doesn't work. If you want to change your tax, you got to change your facts, as they say. And that is it for episode number 107. Again, this is not legal, financial, professional, or any other advice. I am not certified in any of these areas. This is strictly for my entertainment and hopefully yours. Thank you, everybody who's joined. Have a handful of viewers in here. Thank you, Facebook user, looking inside here. Until tomorrow for episode number 108. Have a good one.